So let's talk about closing the books. Now, I know what you might be thinking. Books. I thought we were talking about finances here. But stick with me because when we say books in the world of business, we're diving deep into the revenue, spending, and income summary reports that are the lifeblood of any organization. These reports are like the pulse of your business, showing you exactly how much money is flowing in and out. It's like checking your heart rate. You want to make sure everything is running smoothly. Now, let's break this down. Closing the books is essentially the final phase of the accounting cycle. It's the moment when you take a step back and assess everything that has happened over the past month, quarter, or year. You've already gone through the grind, identifying and analyzing transactions, entering journal entries, posting them to the general ledger, compiling trial balances, and drafting financial statements. But now it's time for the grand finale, closing those books. So, what does it mean to close the books? Well, it's all about zeroing out your temporary accounts. Think of these temporary accounts as the short-term players in your financial game. They keep track of your income and expenses for a specific period, but when that period is over, they need to be reset to zero. This is where journal entries come into play. These are your closing journal entries. They're like the final notes in the song, tying everything together and ensuring that the next accounting period starts fresh. Now, why is this process so crucial? Closing your books isn't just about tidying up, it's about ensuring that your financial data is accurate and consistent. When you close your books properly, you eliminate the risk of carrying over profits or expenses from one period to the next. This means that when you look at your financial reports, you're seeing a true picture of your business's performance during that specific time frame. It's like cleaning your slate, giving you a clear view of where you stand. For small business owners, this process can be a bit daunting, especially if you're not working with a dedicated accountant. Some folks choose to go the route of accounting software, which can make things a whole lot easier. With fewer monthly transactions, closing the books can feel more manageable. Plus, at the end of the fiscal year, many of these programs will automatically close your accounts for you, transferring your net income or loss to your retained earnings account. It's like having a personal assistant who knows exactly what to do. Now, let's talk about the significance of closing your books on time. When you close your books, you're not just keeping your finances in check, you're also paving the way for timely tax filings. This is especially important for small business owners. You want to be able to present accurate financial information when tax season rolls around, right? Closing your books helps you maintain financial honesty and accountability, and it's a great way to keep track of your company's financial health. But here's where things can get a little tricky, the fiscal year end versus the calendar year end. Some businesses align their fiscal year with the calendar year, meaning they close their books on December 31st. But for others, especially those in retail, it might make more sense to choose a different date. Imagine trying to close your books during the holiday shopping rush. Talk about a recipe for chaos. That's why some retailers opt for a fiscal year end of January 31st, giving them a breather after the holiday frenzy. Now, why is the fiscal year so important? It's how businesses measure their success over time. By understanding your financial position within the context of your fiscal year, you can make better decisions about the future. It's all about setting realistic goals, evaluating performance, and planning for what's next. A well-chosen fiscal year can help you budget effectively and predict future revenues and expenses. But how do you determine the best date for your fiscal year end? Typically, businesses look at two main factors: their business cycle and the type of business they are. For instance, if your peak sales occur in the summer, you might want to end your fiscal year on September 30th. If you're a seasonal business, aligning your fiscal year with your busiest time can provide a clearer picture of your financial health. Now, let's dive into the nitty-gritty of closing entries. Closing entries are the various entries made after each financial year to eliminate the balances of all temporary accounts and move those balances to the corresponding permanent accounts. This process is essential for maintaining accurate records and keeping track of your financial progress. So, what exactly are these closing entries? They're your reset button, ensuring that all temporary accounts are zeroed out and ready for the next accounting period. Think of it as a fresh start, like cleaning out your closet to make room for new clothes. It's vital to ensure that all transactions are accurately recorded and transferred to the permanent accounts, which reflect your long-term financial position. Speaking of long-term, let's not forget about the month-end close. This is a process that many businesses undertake to evaluate, record, and balance their financial information at the end of each month. It's all about ensuring that every transaction has been accounted for and that your financial reports reflect the true state of your business. The month-end closing process can be summarized in three main steps: recording financial data, reconciling that data, and finally, approving the closing of the books. It might sound simple, but it can be quite a task, especially for larger businesses with a lot of transactions. First, you need to gather all the necessary information, from financial statements to bank account data. Then comes the reconciliation process, where you compare your transaction records to bank statements to ensure everything matches up. If there's a discrepancy, it's time to roll up your sleeves and figure out where things went wrong. Once everything is reconciled, it's time for the final approval. This is where the principal accountant or auditor comes in to give the thumbs up before locking the books. Once that's done, no one else can access the financial data for that period. If any errors are found later on, they'll be recorded as adjustments in the period they were discovered, ensuring that your financial statements remain accurate. Now, let's talk about some best practices for a smooth month-end closing. First and foremost, transparency is key. You want to have a clear procurement process that allows you to track significant transactions easily. Next, consider consolidating your accounting systems. With today's technology, there's no need for extensive data input. Integrating your systems can save you a lot of time and headaches. Of course, you also want to keep travel costs in check. Processing employee expense claims can add hours to your workload, so streamline that process as much as possible. And remember, quality should always take precedence over speed. Rushing through the closing process can lead to costly mistakes that will come back to haunt you later. Meeting deadlines is crucial, but it's equally important to communicate if you're struggling to meet them. Establishing a consistent timetable for financial reporting helps everyone stay on the same page and keeps your team organized. And don't shy away from looking for areas of improvement. If you notice bottlenecks in your process, take the time to address them. Finally, embrace technology. Automating as much of the month-end closing process as possible can significantly reduce the time and labor involved. From data collection to account reconciliation, automation can streamline your procedures and minimize errors. In conclusion, closing your books is a vital part of managing your business finances. It provides clarity about your financial standing and helps you make informed decisions moving forward. Whether you're closing your books monthly, quarterly, or annually, the process is essential for maintaining control over your finances. So, if you're a small business owner, take the time to master the art of closing the books. It will not only help you track your performance, but also prepare you for tax time and future growth. Remember, your financial health is the foundation of your business, and closing your books is a crucial step in ensuring that foundation is strong. Keep those books closed and watch your business thrive.